Hey there, everyone, and welcome to the Final Bar. It's Thursday, April 4th, and thanks for joining us every weekday after the close for the Final Bar. I'm Dave Keller, the Chief Market Strategist here at Stockcharts.com in a cloudy Redmond, Washington. Interesting day today. If I'm a little disheveled, a little off, I'm just trying to make sense of these markets going into the show. It is fun doing a closing bell show. Let me tell you, don't let anyone tell you differently because things look a certain way around 2 p.m. Eastern. By 4 p.m., everything's different. That is the reality of investing. And what I always try to tell people is they're just getting started with this game of trying to analyze the markets and position yourself correctly. Unusual things happen way more often than you would expect. There's this thing called the fat tail phenomenon. And what that means is if you studied your statistics and you know a normal distribution, kind of that bell curve, it has a very small likelihood that really unusual things happen, right? That's that really narrow sort of long tails that you have. But the financial markets have what are called fat tails, meaning the highly unlikely scenarios, both to the upside and the downside, happen way more often than a normal distribution would imply. And a lot of us sort of expect that normal behavior in all things. And so big moves, unexpected moves, sort of 3, 4, 5 standard deviation things happen a lot more often than you might expect. And that's what makes the financial markets so fascinating and frustrating and challenging and rewarding all grouped into one. Hopefully on a day like today, we can help you make sense of things. And we have a great guest today, Sean McLaughlin of Stockcharts. I'm going to ask him, how he handles a day like today, and I hope he can give us some words of wisdom to help us survive the next one a little better. With that in mind, let's get to the market recap and see how things played out through the course of the day today. Before we get to the charts, I do want to share a poll we had going on our social media platforms, so make sure you follow us anywhere you see Stockcharts or Stockcharts TV. And we asked you, if this bull market is a football game, which quarter are we in? We're nearing the NFL draft. Thinking Seahawks here. I'm thinking Browns, where I grew up in Northeast Ohio. Whatever team you're in, think about what quarter we're in. Are we in the first, second, third, fourth quarter, or are we in overtime? I'm struck as I look at the results of this poll that we had running over the last 24 hours or so, how evenly spread we are, right? We've got 15% of viewers saying we're in the first quarter of a bull market. I've got 20% of you saying we're in overtime. And I would tell you, that even spread, the fact that there's no clear winner, although the second quarter, 25% got the most votes. But having said that, it was pretty widely distributed across all of these different quarters. So it tells me we're not quite sure, and that's exactly how this feels. When you look at some of the market conditions, you look at some of the distributive candle patterns I'm going to share with you here on some leading growth names. Some of the things that opened higher and closed lower, the fact that our market trend model may be turning negative here. Today, the S&P short-term version did turn slightly negative at the close. A lot of uncertainty here. Let's look at some of the charts together and see what lines in the sand we can define, see if any of those lines were broken today. Starting with the S&P 500 and the other major equity averages on the front page here, a lot of red except for the VIX, which did in fact go above 15. We'll come back to that in a minute. The S&P 500 down 1.25%, closing just below 5150. The NASDAQ composite down even further, down 1.4%, and that gets the NASDAQ composite to just below 16,050. The mid-cap and small-cap index is down as well, but small caps actually performed better than mids and smalls, which is a little different look than we've seen here recently. The VIX did push above 15, and we've seen that happen a couple times, but we've closed back below it. The VIX actually closed a full 2 points higher to be just around 16.4, which is one of the highest readings we've seen here in 2024. We'll look at that chart here in a few moments for sure. Interest rates overall moving lower. So you see stocks down, bond prices up. So the 10-year yield finished around 4.31, the 5-year point just below 4.3%, the long bond yield dipping below 4.5%, and the TLT, which is a bond ETF, Treasury bond ETF, closed up about 0.75%. The dollar really no big change from yesterday's close. Looking at commodities, I put an article in for CNBC earlier today talking about gold and gold stocks. Today, gold giving back some of those recent gains. Gold pretty much breaking to new all-time highs here in Q1 going into Q2. Today, the GLD was down about 0.6%. Silver prices down 1%. Copper prices slightly lower as well. Crude oil, one of the few spots of green here on our commodity ETF list. The USO was up about 1.25% from yesterday's close. Energy had a pretty decent day relative to other sectors. Bitcoin continuing to be volatile and unpredictable in a lot of ways and just having a lot of movement. Bitcoin here in the last 12 hours or so has gotten up to 69,000, pulling back here a little bit as we're shooting the show here today, right around 67,600, we'll call it. Ether prices just below 3,300. Bitcoin is sort of moving higher, generally speaking, although it did give back some of those previous gains during the equity market trading, particularly in the last hour or two. We've seen the drop around 1,500 points in the chart of Bitcoin. Bitcoin's really consolidating more than anything, right? And if you look at the S&P, the NASDAQ, Bitcoin, a lot of charts in the tactical, in the short-term time frame, not still going up, not really going down, but more sideways than anything. I think that's a fair way of describing the short-term environment on some of these charts. Looking at our S&P sectors, all 11 of them, you can see all 11 finished in the red earlier in the day. A bit of a mixed results here, but everything kind of getting dragged down going into the close. Energy almost finished in the green, but did finish slightly lower. Utilities and consumer staples are your top three performing sectors. At the bottom of the list, we have technology down 1.6%, healthcare down 1.4%, communication services down 1.3%. The problem there is two of those sectors, comm services and technology, a lot of market cap represented, so those struggling certainly weighing down on the major averages. Looking at the air quotes opened magnificent closed 7, we can see that Tesla and Meta were actually higher. You know, Meta's a really interesting one. It ended up being what we'll probably call a shooting star candle, I would say, is how I would describe it. I was sort of watching going into the close. It was moving a lot. And I'm thinking, all right, I'm just going to have to wait until after the close to figure out what this candle is going to look like, because it was pretty noisy. Make a note that at the bottom of the list, you have NVIDIA down almost 3.5%, Alphabet down almost 3%, Netflix down 2%. Now, names like Netflix just really making new all-time highs during the day today, but by the close actually breaking down a little bit. We'll look at those candle charts, again, time permitting if we can here. Got a lot of charts I'd love to get through with you, so let's get going with some of the individual charts. We'll start with the S&P 500 on a daily basis, and what you have here is what is called a bearish outside day or a bearish engulfing pattern, depending on whether you're using bar charts or candle charts. I talk a lot about candle charts, but bar charts are pretty interesting methodology. And if you look at what's called a bearish outside day, it's a 2-day pattern where the price bar of day 2 has a wider range than the price bar of day 1. You have an up day and then a down day. Very similar to a bearish engulfing pattern in candlestick methodology, but a bearish outside day is not particularly bullish here in the short term. It's bearish as the name would imply. What's also true as we close at the lows of the day is this makes a close below 5,200. Now, we've highlighted this level here in the last couple weeks. That was that last big breakout, which is now feeling like sort of that last gasp higher here in mid-March, third week in March. We gap up and close just above, well, that's not true. We traded up to around 5,260, which is the high for the cycle here. We pulled back to 5,200, bounced higher, bounced lower, and we're sort of in this little mini range between 5,200 and 5,250. Today actually pushes below that, right? So we've closed below 5,200 now for the first time since breaking above there mid-March. So the question now, I would argue, is looking forward to Friday. Do you see additional distribution, what we'd call a follow-through day? Today was a distribution day in that we opened higher and closed lower. That shows, obviously, there's a lot of selling in the last 2 hours of trading. Do we see additional distribution tomorrow? Do we see signs that we're just getting started? That, I think, is what ends up being a lot of times what's called a negative feedback loop, right? Where we just kind of keep getting more negative data. That feeds additional selling. The additional selling pushes prices lower. This is how a waterfall decline can become very magnified very quickly. There is hope, though, and again, we've talked about lines in the sand. That was my short-term tactical support. I think now this means, to me, highly likely we kind of get down to this 50-50, 50-75 range. That would be the 50-day moving average. That would be that last big price gap from mid-February. We hold 50-50. Things are just not that bad. We break 50-50. I think this is a concerning market, and we will immediately start thinking about further downside objectives. I've got some great Fibonacci charts all queued up for you, ready to go when it's the right time to do so. I don't formally update my market trend model until the end of the close on Friday, so I don't want to get too ahead of ourselves. But if today was Friday, we would have a short-term market trend model turning negative for the S&P 500. And again, I don't officially lock this in until Friday. It's a weekly chart for me, and every Friday at the close, I look to see if there's any change. But it's worth noting that given today's sell-off, that does get us just barely below the 5-week exponential moving average, and that would mean for me that the short-term model would turn negative. We've talked about my market trend model before, and that short-term model turning negative pretty much is the first thing you would see at a major top, right? Once the top has occurred, we have that initial sell-off that would turn the short-term model negative. I think things could really get concerning when the medium-term model turns negative. That's when it means it's more of a significant decline, really starting to push the trend lower. So still early days, but worth noting that initial sell signal may have been triggered here. I just want to go quickly through some of the other charts in the Mindful Investor Live chart list just to see what today's move means relative to the longer term trends we've talked about. We highlighted what's called a bearish non-confirmation with the Dow theory. This is actually a chart I call the newer Dow theory, which has an equal weighted S&P and an equal weighted NASDAQ 100. And what I mean by a bearish non-confirmation is late March, the S&P made a clear new all-time high. And again, this is the equal weighted ETF, ticker RSP. The bottom series you can see is the equal weighted NASDAQ 100. It actually did not confirm that new high. So it's a bearish non-confirmation where one of the indexes breaks out, the other one does not. The real sell signal is where they start to break down. What's interesting is today's close does make a new swing low for the NASDAQ 100, again, equal weighted. I'll look to see if the equal weighted S&P gets below that low from March, and I think that would be a fairly negative signal for the S&P and really for the broader markets. This is a chart I just called the chart, which highlights some of the key metrics we'll talk about. Here, what stands out to me is that the bullish percent index from the S&P 500, today's close did push below 70%. It finished today around 68%, which means still 2 out of every 3 S&P stocks is still in a bullish point and figure profile, but more and more of them are starting to not be bullish, and that's the problem. Here's the advanced decline data for the major averages, the New York Stock Exchange, S&P large cap, mid cap, and small cap. Not all of these are updated for today's close just yet. I don't think we'll get any real negative signs for this yet because this is looking at cumulative advanced decline data. Now, this is going to tell me probably the conditions are still okay. These breaking below the 50-day moving average is what I look for as a warning sign. That's why I have these on here, these blue lines. So keep an eye on this chart, I think, going forward to see if and when we break below that 50-day moving average. Last time that happened was back here in August, pretty much right after that August peak. That's what I'm looking for, is that kind of bearish confirmation that the breadth data is turning negative. Not enough of that just yet to turn sort of medium-term negative based on that chart, but the McClellan oscillator definitely is turning negative. This is actually, over the last couple days, the McClellan oscillator has gone back below 0. That, for me, tells me short-term breadth is more negative. That tells me to be thinking more down than up until we get back to the McClellan oscillator above 0. Not going to happen today. This is not updated for today's close, but it's going to dip lower given the advanced decline data that I'm observing here going into the close. So overall, that tells me expect short-term weakness rather than strength until that starts to revert higher. Again, still 68% of the S&P members above their 50-day moving average. That's not a bearish reading just yet. You look to see when that breaks below 50%. Again, this is what happened in mid-August. And not that I think we're going to have a repeat, like a 3-month decline, but we have in recent market history a really good example of a nice uptrend that certainly felt like we're going to keep going and going and going until all the conditions change. So what's helpful about charts is you can immediately look to the left and say, okay, August was a pretty good peak. And if I knew that we're going to have this retracement, knew I wanted to get out of the way, and then maybe have an opportunity to buy in a little bit lower, what do I see today that rhymes with that previous period? And so look at some of these indicators, particularly where the validation of the negative breadth really confirmed that we were in for more of a protracted decline. That's what we have not seen yet, but that's what I'd be looking for on that particular indicator. The bullish percent index for the S&P did break below 70%. That has usually been a pretty consistent sell signal for me. The last signal did not work particularly well. Full disclosure there in mid-January, you got a sell signal that didn't work at all. The market continued higher, but that's sort of the nature of this business is things are not 100% accurate ever. However, recognizing that that's happening again does tell me to be a little more cautious than anything. The NASDAQ 100's bullish percent index now well below 50%, and this keeps going down, right? This is at 90% at the end of last year. This is down now below 50%. So it shows you how much the growth leadership names have really rotated lower, and I think that's one of the issues we're running into. Last chart here, and then we'll look at a couple individual names to finish off our market recap. The VIX closing above 15. Now, this has not happened too often here in 2024. A couple times, and each time it's been a 1 day or 2 day thing, and we've gone right back below 15. For me, a VIX spiking above 15 is that initial red flag that tells me, all right, we are now in a potential pullback phase. A VIX above 20 is where it tells me things can really get ugly. So for now, this is just telling me it's an initial cause for concern, and today's sell-off is telling me to be ready for further pullbacks. And what that also means is particularly to be making sure that you have stops updated to make sure you're unwinding positions that start to hit your triggers, and just make sure while you're still not too far from all-time highs, hopefully in some of your positions, now is the time to identify those lines in the sand if you've not done so already. Just to finish off here, I want to show a couple individual names here with the time we have left. Meta Platforms, this looked like a really good chart earlier today. I'm looking around lunchtime Eastern, it's around 9 a.m. Pacific time here in Redmond, Washington. I'm seeing Meta get up to around 5:30. I'm thinking, oh man, like the FANG stocks are blowing out to the upside. This is, how negative do you want to be if these names are able to break to new highs? But it's a great reminder as to why you really want to wait for the close to lock in what today meant. And once you get to the end of the day, you see there was broad selling going into the close. This all of a sudden becomes a pretty bearish short-term pattern. This is a shooting star candle that's happening right as we're attempting to break above the previous highs from last month. So we opened here around 516. We trade all the way up to 530, but by the close, we've undercut the open, and we're down to around 511. That's called a shooting star candle. The fact that it happens right at resistance suggests to me the next 1 to 3 bars are most likely down rather than up. Tells me to be out of the way, watching out for further downside potential. Netflix is featuring a different candle pattern. Do you know this one? Those of you that are candle pattern aficionados. If you don't, this is actually called a dark cloud cover. They're picking through the depths of the candlestick playbook. A dark cloud cover, if you know the bearish engulfing pattern, that's where you would have a big up day and a big down day, where day 2 engulfs the range of day 1. That's a bearish engulfing pattern. But if it doesn't get all the way to engulf day 1, but it's at least 50% of the way through day 1, it's called a dark cloud cover, and it is also a bearish pattern. So again, you have another leading name, Netflix, trading up to a new all-time high during the day, but by the close, we have a bearish candle pattern suggesting a confirmed test of resistance and short-term distribution going into tomorrow's session. Amazon also featuring the dark cloud cover pattern. So very quickly, I was planning to talk about the resilience of these Magnificent Seven names, charts like Meta, Netflix, and Amazon blowing out to new highs and having this strong behavior, which certainly felt like an sign of optimism in the short term. At the end of the day, it's a very different look. And as I go through these charts preparing for tomorrow, I'm thinking more distribution than accumulation, particularly in the short-term time frame going into Friday's section and into the beginning of next week. That's it for our market recap. We have a great guest today, by the way, Sean McLaughlin of All-Star-Charts. He always brings some interesting, thought-provoking charts and great insights with him. A couple quick announcements before we get to Sean's discussion. First off, we welcome your questions, particularly for our the Final Bar mailbag. We're going to do an all mailbag episode Friday of this week, and we'd love to feature one of your questions in our next mailbag show. Email is the best way to get your questions to us, thefinalbar@stockcharts.com. On X/Twitter, just tag us in a comment at FinalBarSCTV, and on our YouTube channel, just put a comment below the video that you're watching here. We'd love to hear from you, and we'll hope to feature your question in our next mailbag episode. Also, as a reminder, I will be speaking at the Money Show Investment Masters Symposium. I did a couple of these, or certainly one of them last year in Las Vegas. It was great. It was a really interesting environment, great group of attendees, smaller sessions, very interactive. It was really worth it, and I would encourage you to attend if you've not attended one of these before. This one in particular, May 7th through 9th, will be held in Silicon Valley, so right in the Bay Area. I'll be doing a short 45-minute workshop on one day, and then also be doing a 2-hour masterclass called 7 Questions to Ask Before Every Trade. I'll actually share with you the technical analysis checklist that I've developed over my career. We'll look at some examples together. I'll take some tickers from those of you in the room. And please make sure if you attend, you say hello and that you watch the show. You can scan the QR code on your screen to sign up for that event, or just click on the link here in our description, and look forward to seeing some of you in Silicon Valley, May 7th through 9th. I want to welcome on today's guest, Sean McLaughlin. Sean's the Chief Options Strategist at Stockcharts, coming to us from Boulder, Colorado. Sean, welcome back to the Final Bar. How are you these days?
Hey, thanks for inviting me on an exciting, thrilling afternoon. Markets sliding all over the place. Woo! It's been a white knuckle ride over here.
It's been fun. I always have to give an extra thank you to guests that are coming on these particular types of days. We were talking before. It's like we start prepping for the show, and then everything seems to change. But that's real life, and that's what our viewers are certainly struggling with. So hearing how someone like you deals with a day like today, I think will be very very helpful for a lot of people. We're starting with your chart of the Ark Innovation Fund. Interesting with how growth stocks have been in such a leadership role. Ark Innovation Fund, ARKK, is sort of sideways here. Do you see more of that going forward or something different?
Yeah, I'm glad we're starting here. And, the theme of the afternoon with the market slipping, it feels like there's some change coming our way, perhaps, right? And this Ark trade here is an example of the change that we think might be in the offing. The market, the bull market that we've been in since the October lows has been truly remarkable, right? I mean, across the board, we've seen sectors and individual stocks just ripping higher. I mean, the S&P has gone on basically a 45-degree angle higher pretty consistently since then. And so our feeling here at Stockcharts, and me in particular, I feel like it would not be surprising at all if we had a little bit of a market pause here, maybe even a small correction. I'm not saying that the top is in and that's it for this bull market, but it wouldn't be surprising at all if we had a little bit of a pause. And so with that in mind, we're looking for ways we could weather the pause, so to speak. And one way that I like to do that when I think that we're due for some sideways action or some sloppy trading actions, I love to look for delta neutral options trades to get paid to wait out the storm, so to speak. And an instrument like ARK here, ARKK, it's an ETF, as many know. And as you can see on the chart there, for most of this year, even going back to December, we're basically in a sideways range, not really making any headway in either direction. I believe that's a 50-day moving average you got there that we're kind of hugging there pretty tightly. So an instrument like that with implied volatility in the options having some pretty good premium, and in fact, even more premium this afternoon as the markets are sliding and people are getting a little afraid, that drives options premiums. And so right now, we like selling a strangle here. We're selling out of the money calls and out of the money puts in May, doing it delta neutral, getting paid a credit. And as long as ARK stays, let's say below 53 and above 44, we like this trade and we're going to keep it on and try to eke some profits out.
Right. So that is you're describing, I think, an option strategy. We are basically betting on that consolidation to continue, right? We're sort of remaining in this range. You used the phrase delta neutral a couple times. For those that are uninitiated in the world of options, can you explain, like, what does that actually mean when you're making a delta neutral bet? What are you betting on or against?
Sorry, I use these terms so often I forget when I'm saying them. So yeah, let me clarify. A delta neutral options trade is a trade where you're making a bet that the underlying instrument is not going to move too far in either direction, right?
Right.
The delta referring to the rate of change of the position, right? If the delta is zero or close to zero, then a $1 move up or a $1 move down in the underlying is not going to change the value of the position all that much. So that's the kind of thing. And you could do delta neutral trades where you are betting on a big explosion. That's where you buy, let's say, an at the money call and at the money put. We call that a straddle. I don't do a lot of those trades. I do them occasionally. More often, I'm doing delta neutral credit spreads where I'm betting on sideways ranges and I'm selling out of the money calls. I'm selling out of the money puts. I mean, ideally, they just expire worthless and I keep all the credit that I earned up front. I generally take them off before expiration just to don't want to hold that risk all the way. But they're great instruments for sideways markets, especially when you're getting paid good premiums to do it, which we are right now in ARK.
It's so interesting to hear that sort of description, because I feel like as a plain vanilla equity investor, I think many viewers probably are, you're limited, right? Particularly when there's no movement, you have no opportunity. But with options, it really opens the door to a lot more opportunities. Betting on different directions, that sideways direction, I feel like, is happening a lot more than we've been used to here recently. Great example there, by the way, with Ark Innovation Fund. Your second chart, you're dropping a monthly chart on us of the energy sector. What do you see on this chart? What does it tell you about possibilities going forward here in Q2?
So speaking of change, if you look at this XLE chart, this is a monthly chart. We're looking at 15 years, 20 years of data. And if you notice something, if you're paying attention in that upper right corner, it looks like we might be finally breaking out of a monster 15-year base. And if you drill in even further, you'll notice that since, let's say, late 2000, or sorry, late 2020, just after the COVID crisis, we see prices of the XLE ETF, which is the energy ETF, it has tripled off of that low. And the bet we're making is that if it can triple off that low in 3 years, give or take, why can't it double, at least double over the next 2 years if we're getting a meaningful breakout? And with that in mind, David, the options premiums in XLE right now are very cheap, mostly because we're at the highest levels we've been in 15 years, right? That when something's that high and it's never been this high before, there's not much fear in the market. So options premiums tend to be pretty muted. And we looked at the options chain and we said, oh my goodness, we can go as far out, with options being so cheap, we can go as far out as December 2026, David. That's 3 years from now. Those are leaps. Leap options are long-term options. We could buy, for example, a December 2026 $130 strike, which is a 30% move from here. We could buy that 130 strike for $5. $5, David. And do you think that XLE could move $30, $40, $50 over the next 3 years, given what it's already done in the past 3? It's some low-hanging fruit. We're making a big bet here at All Star Charts. We think that this is a big move that can play out over the next couple of years, and we think the options market is pricing an attractive opportunity to really position yourself for a big move.
It's really interesting when you combine the time component, right? Because you're thinking of this expiration a couple years out. So you're really thinking about the possibilities between now and then, right? I'm curious, when you're looking at an opportunity like energy, obviously a lot of individual energy stocks are breaking out or really appreciating. How do you determine whether you want to make an options bet using an ETF versus one of the group ETFs like the oil services or an individual stock? Is it based on the premium and how they're quoted at this particular moment, the volatility that's priced in, or is there some other deciding factor for you?
It's on a case-by-case basis. I could tell you in this case, when we were kicking it around in our internal meetings, we were looking at some energy names, specific energy names, and we said, look, if we're playing for a long-term move, the whole sector is going to go. Why try to pick the one winner? They're all going to win. Let's do the ETF. Let's keep our lives simple. And you're going to get just as much beta with the XLE as you will in, say, I don't know, ExxonMobil, perhaps.
Right. Yeah, no, really interesting. I think that's well said, Sean. Obviously, you're coming on one of these days, which I feel like happen more than they don't, where you have a big reversal. The day has a particular configuration, then the last hour or two totally changes. Can you give some words of wisdom here for those that are just starting to experience these days? How do you weather a day like this? I mean, what goes through your mind as you see things rotate? Are there particular levels or signals that you look for, or do you just wait to see how things play out? Like what goes through your mind on a day like this?
No, that's a great question. If you're zooming in on an intraday chart, like you have right there, that small chart you got on your screen, and you look at that, that's a pretty scary look. Like, whoa, what a waterfall sell-off. The market's crashing. You could easily think that by looking at a chart like that. I do this myself, and I tell it to people all the time. When you have a day like this, and all of a sudden it hits you that you weren't expecting it, you were not expecting this type of move, you were not prepared for it, before you start making rash decisions to exit all your positions and head to cash, maybe take a few minutes to zoom out, maybe look at a daily chart, then look at a weekly chart, then look at a monthly chart. If those long-term trends that you've been betting on are still mostly intact, one day is not going to change a market. Now, could this be a harbinger of things to come? Of course, but we're going to have time to position when that, if we need to. But zoom out whenever markets get dicey like this. Whenever the market throws you a curveball, zooming out is always the savior to gets you back, gets you centered, to gets you thinking clearly and thinking better tactically.
I love that. I love that answer. I always tell people make short-term decisions with short-term data, make long-term decisions with long-term data. again, included a monthly chart of the energy sector to sort of make that case, I think, very, very well. Final question, Sean, we have about less than a minute left, but as you're looking at this environment, you mentioned a couple ideas with ARK, with the energy sector. All of this, of course, is happening within the general movement of the markets. We're at or near all-time highs, but showing some short-term distribution. How do you connect sort of the macro discipline of this is the overall phase we're in versus an individual opportunity like energy or ARK? How did those relate in your process?
Well, I could tell you for me personally, and I wrote about this in a piece that just went out this afternoon about how, and we even talked about it earlier, like we've had such a big run in stocks. And at this point, if you're not being disciplined and not tightening up your stops on long positions you've been in for a while, you're just being greedy. Okay. And, greed is okay sometimes in the right environment. But when you've had a big run like this, you need to say, okay, we could be due for a pullback. Let's tighten up stops. I'm still looking, I'm still on the hunt for bullish positions here, David, but I'm not looking to be too aggressively bullish. Like that XLE trade we were just talking about, that to me does not feel aggressive. I'm paying $5 for out of the money calls that have 3 years to expire. I mean, XLE can get cut in half tomorrow and I might lose, 30% on the value of those calls. I mean, I'm not worried about it. That doesn't feel like an aggressive bet to me. So I think an environment like today, or what's happening today, the signal that the market is sending right now, I think we would all do better by taking our time, maybe, waiting for better entries. There might be a better entry if you're patient, maybe being a little bit more conservative, maybe trade a little bit smaller, maybe instead of going for home run trades, just go for the singles and doubles, that kind of stuff. That's how I'm adjusting right now. Yeah. Talk to me in a week and I might totally change my mind. But for now, that's where my head's at.
If the market conditions change, I'm sure you will try to adapt as well. Sean, this is awesome. Thanks for joining us, particularly on a day like today. I think it's really helpful for people to hear how you make sense of things and, again, looking at particular opportunities. So thanks again for joining us, and we'll talk to you again next time, all right?
All right, David. Thanks for having me. I'll see you next time.
That's Sean McLaughlin. Sean's the chief options strategist at Stockcharts, come to us from Boulder, Colorado. And I love that description about how you your ideas come from an analysis of the charts, to paraphrase what Sean was saying, but there's also this sort of macro backdrop, right, and understanding how the conditions are. So maybe based on what you're seeing, you're a little less aggressive, you're being thoughtful about which positions you take, but again, if the right opportunity presents itself, like we were discussing as an example, something like the energy space, right, recognize a good opportunity in any environment. I always tell people it's always a good time to own good charts. Great take there, as always, by Sean McLaughlin of Stockcharts. We've got to wrap this show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. So in our market recap, we talked about the McClellan Oscillator, and this is really a short-term breadth indicator. I use other things like the cumulative advanced decline lines as more of a long-term breadth indicator, things like percent of stocks above their 200-day. I think those are great long-term breadth gauges, trying to recognize bigger shifts. But recognizing shorter-term movements can be really helpful. Even if you're a long-term investor, understanding the short-term environment and whether there's weakness or strength dominating can tell you a lot about having more actionable entry and exit points, or more effective entry and exit strategies. So the McClellan Oscillator has now flipped below 0. Again, not updated yet for today's close, but I would imagine when it is, you will have further downside below that 0 line. That is a sign of short-term distribution. Chart number 2 is Bitcoin. We talked with Sean McLaughlin. We didn't talk about Bitcoin, but we did talk about the Ark Innovation Fund and how we're in that consolidation phase, right, of lower highs and higher lows, that sideways environment he talked about with the Ark Innovation Fund. I would say Bitcoin is very much in one of those sideways patterns as well. Now, I think compared to the Ark Innovation Fund, Bitcoin is really in a very well articulated coil pattern, which is where you have lower highs and higher lows. In the last couple of days, it's really made that lower rim of that, or lower edge of that pattern very well defined. What's interesting about this pattern, usually John Murphy taught me about 2/3 to 3/4 of the way through the pattern, you usually get a break, and we're kind of getting pretty close to that. And really, direction is not necessarily implied by a coil pattern. It's sort of a sit on your hands, wait and see mode, and look to see which one happens first. Do we break above the upper boundary, or do we break below the lower boundary? For now, we're sort of rotating back toward the upper edge of this, but I would wait to see which way we break, and whichever way we break, I would assume that that direction of momentum is probably the next leg to expect for Bitcoin. Finally, boy, a day like today, causing all sorts of stops to potentially get triggered. AbbVie is one of those biotechnology names getting sold off pretty aggressively today. Healthcare is not a particularly strong sector. And the reason why I want to highlight a chart like AbbVie is two things. Number one, look at when you have a day like this, if this caught you off guard, just look to the left and recognize how the conditions have been setting up, right? Back in mid-March, we're recognizing that this is a bearish momentum divergence with higher highs in price and weaker momentum. About a week ago, we're recognizing a failed attempt to make a new high. So instead of making a new all-time high here above 182.50, it's failing to do so. So while today's drop to the severity that it was may have been unpredictable, the fact that this has been rotating away from a clear bullish trend to more of a questionable bullish trend are the types of leading indicators you want to get familiar with. If you missed it until today, make sure you have something like the chandelier exit, something based on average true range, even something as simple as the 50-day moving average or just a percent stop. But have something in your toolkit that helps you get out of a name that is really starting to struggle and wait for that better opportunity to present itself. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. A special thank you to Sean McLaughlin of All Star Charts, joining us from Boulder, Colorado. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.